Hello everyone and welcome to another edition of ChartYourTrade.com's free webinar series. I am your host, Michael Lamott. I am the founder of ChartYourTrade.com, and today we'll be discussing an introduction to risk management and position sizing, part 1. With us again is keynote speaker Adam Sarhan. Adam is the founder and CEO of Sarhan Capital, which is parent to FindLeadingStocks.com. Without further ado, here's Adam.
Let's do a quick overview of the DAMP investment system that helped me create and formulate my strategy for handling markets and dealing with all types of facets of investing. The first letter is D, is defense first, and that's going to be a big focus tonight. We're going to talk about respecting risk. We want to win by not losing. We want to define and quantify the risk before you enter a trade and then mitigate your surprises. That's really helps frame the thought process. A lot of what I discuss are broad concepts. I look at trading and investing more of an art than a specific science. And from my point of view, I want to give broader context of the concept so you can understand and then apply it however you feel necessary. Because having too granular approach or too detailed, you get caught up in rules and all these different things. And you can't check one box out of 30 boxes. You miss a stock and the stock takes off, and you're just left because every single minute detail wasn't followed. So what I found has been a much better approach is just to understand the concepts and then apply them loosely with discretion, and that's been very, very helpful. Of course, it's a rules-based approach, and here's basically the outline of the investment system. The A stands for advanced buy and sell signals. The idea there is you want to enter correctly and exit correctly, and part of that entering correctly is buying closer to support and or within a base before it actually breaks out. Sometimes you can buy the breakouts, but not have that as your primary tactic, more of a secondary tactic or as an add-on or a pyramid. And this way, getting in a little bit early allows you to do two things. Take a larger position because your exit is closer, and also allows you to get in and out before the crowd. It reduces your risk. So there's several different benefits of getting in earlier using those advanced buy and sell signals. And then the market conditions is the M in DAMP, and that stands for basically you don't want to fight the tape. Follow market trends. The whole goal of this business is to align ourselves with what is actually happening from my point of view, not to force my opinion on the market. And it's a humbling process, and you've got to put your ego aside and realize it's not about being right or wrong. It's about making money, and that's it. The best way to make money, in my opinion, is to interpret what you see actually happening right now, put predictions aside, and then interact accordingly and be flexible. When the facts change, you have to change. If not, market. There's a good old adage on Wall Street that markets can remain illogical a lot more than you and I can remain solvent. So keep in mind that you want to move along with those trends opposed to fighting them. And then psychological analysis, P, is really an important area that I've helped frame everything together. We know technical analysis, we've all heard of fundamental analysis, but there was a part that was missing for me, and for years I was struggling early in the career. I wasn't able to really pinpoint what it was, and I realized it was my own psychology, not just myself, but also markets. So I've studied every major economic cycle going back to the 3rd century. I've studied countless bull and bear markets on my own. I've done a lot of research, and a lot of it's available online and on the websites, but what I realized was that there was just a gap in actual, from a psychological standpoint. So after studying all these different booms and busts and different economic periods, I noticed that everything changed except for psychology. The one constant throughout market history is basically fear and greed, or the human psychology. Now, even today with computer trading, realize that computer trading, it's programmed by somebody, and also it's meant to interact and interpret what's actually happening, and that's just a reflection of all the collective psychology of the participants. So when you know yourself and you're able to understand the psychology and realize that price itself is determined by perception, that's the most important variable as far as I'm concerned to determine price. It's what market participants perceive to be a good value or good price for that stock, not necessarily technicals or straight up fundamentals, because lots of times you see stocks with strong patterns and the breakouts or the patterns just fail, and vice versa. Weak patterns and the stock could take off, and also you have stocks that take off with weak fundamentals and strong fundamentals. So that it just wasn't a complete picture, but that psychological analysis part really brought everything together. And that's the overview of the DAMP investment system. Tonight we're discussing the D. This is actually from the slide from an all-day seminar that we gave a while ago. But let's look at risk management. So one of my my quote is, being successful in the market is largely a function of successfully managing risk. What does that mean? Lots of times people, beginners and institutions, or advanced, intermediate and advanced participants, they only look at the reward side of the equation. They ignore the risk side, or they don't properly quantify their risk. What does that mean? So most people are taught, you buy something at 10, you put a protective stop loss in, 10% below, 7% below, 20% below, 5% below, whatever number, arbitrary number they pick out of a hat, below their entry point, and that's your risk management. The problem with that approach, again, after years and years of just having it not work for me and following other people's rules, I said, okay, let me just reverse engineer everything, start from scratch, and then figure out something that actually works. So what I was doing, I was managing money for clients based on a popular investment system. I said, okay, let me follow all the rules, and all that's great. And I met lots of other people, spoke all around the country, and I realized that the people were nobody was really thriving in that environment. So I said to myself, I'm like, all right, well, what's missing? Let's say you have a portfolio, you buy something, and it goes down 10%, and you're stopped out. Well, how much of your portfolio do you put to work in that idea? That's a missing. What happens to your bottom line? That's not addressed. Buying something at 10 and selling it at 9, or selling it at 9.50 because it's down X% from your entry price, is only one part of the equation. The more important part for me, I learned, was, okay, let me just focus on the actual bottom line of my account and preserve that. And that's where this whole, we'll get to that in a second here, with the 1% of your portfolio comes into play, where it really becomes a function of what is my overall risk based on my portfolio, not from my entry to my exit point. So that's crucial to understand. The other critical component of risk management is that every single major and minor failure on Wall Street in the entire history of capital markets, going back before Wall Street even, was due to one simple factor: not respecting risk. So by paying attention, focusing, quantifying, and studying risk, you're way ahead of the game. And that's why it's defense first. It's the first part of the investment system. Or the methodology, or however you want to word it, semantics aside, it's the first component that goes into my thought process when I come to enter a position, exit a position, whatever the case may be. At the end of the day, the only thing that matters, and the most important thing in this business, is whether or not you make money. Everything else is secondary. So for me, price is primary. Everything else, including volume, and we'll get there later in a different conversation, is secondary. So the only way in this business to legally make money that I know of is to see based on the difference between your entry price and your exit price. And what happens to your statements each month? Do your statements go up, or do your statements go down? You even use days or weeks, or quarters, however you want to use it, years. But without having your statements increase in value, there's no other way to win on Wall Street. So that being said, paying attention to risk is paramount to achieving long-term success in the market, from my point of view. So the biggest mistake people make, and this is not just beginners, these are also quote unquote experts or advanced. Look at these firms, Lehman's and Bear Stearns and AIG, Washington Mutual, Wachovia, long-term capital management, and these are different decades. It's not like it's just in one crisis. This happens time and time again. Again, human nature is the one constant in markets. So that greed comes into play. Leverage is a tremendously powerful, but also could be detrimental tool when misused. Tool that most people don't understand because they don't define and properly quantify their risk. So once you're able to do that from your portfolio's point of view, you're way ahead of the game. So how do you respect risk? First of all, you define it. Okay, I have, let's say, $100,000 portfolio. I want to risk 1% of my portfolio on any one idea at any given time. This 1% rule I didn't come up with. There's a lot of research on the topic, which you can Google afterwards and really do your due diligence on. I urge everyone to do that because each person has a different threshold for risk. I know large institutions that are extremely successful and put up great double-digit returns every year on average that risk 0.2% of their portfolio. And I know people that risk 1 and everything in between, and I know people that risk more and are successful. But typically, the 1% is a magic number as far as not too much risk, not too much reward, somewhere in that sweet spot. And it'll help you from suffering large dramatic drawdowns. It'll soften your swings, your P&L swings, your equity curve, and it'll also help you achieve long-term success. Because again, if you take too much risk and the market or trade goes against you, not only will you be zero, but you could possibly be, owing the broker money, having a margin call. So really using leverage the right way is important, but also quantify the risk to your bottom line. what happens to your portfolio? And that's really important. So let's say you do all your research, you find the quote unquote right stock. Okay, so you do your homework, the fundamentals, check the box. You could check 30 boxes there, or 50 or 5, or it doesn't matter. It's technical, same thing there. Okay, great. Even the psychological component, great. The perception is the stock's undervalued, it's going higher. However you want to word it, no problem. It's a momentum stock, whatever label you want to use, no problem. Then what? So here's where the logic comes in with defense first. What do you do when you find the right stock? How much of your portfolio do you put to work? How many shares should you buy? Where do you exit if you're wrong? More importantly, what happens to your bottom line? So I've developed 3 really important questions that I use. First of all, when do you enter? When do you exit? And how much do you lose if you're wrong? And that's it. I'm a big fan. Actually, Mike and I were speaking earlier today about it, just keeping things simple. And there's a certain genius or elegance and simplicity. Most people have the exact opposite tendency. They try to overcomplicate and overthink things, and that's part of the psychological analysis component, where you are your biggest enemy at a certain extent, because without forcing yourself, they can't believe it's quote unquote that easy or that simple. Now, there should be mentioned that there's a big difference between something being simple and something being easy, and also a big difference between something being simple and something being stupid. So keep that in mind, as simple does not mean easy or stupid. It just means simple. And if you're able to, they teach us, teach our children in school to simplify our fractions, reduce always simplify whenever possible, especially when you're in a complex scenario or environment with a lot of moving parts. I've learned that by doing this, it propels you way to the top 1% of investors and traders out there. Just because most people do the exact opposite, and then they get caught up with 30, 40, 50 rules that they need to follow every single box, and they can't check every box, they miss it, or they do it, and then they miss, blah, blah, blah. So what I've learned over all these years has been, okay, let me just keep things simple. There's 3 things I want to know. When am I going to get in? When am I going to get out? And how much am I going to lose if I'm wrong? Now, how much am I going to lose means how much of my portfolio will be affected if I'm wrong. How to define your risk? Well, the first component is that 1% rule that we briefly touched upon. So with that example, a lot of people ask, well, how many units can I buy? We'll get there in a second. So you have a $100,000 portfolio. 1% of that is $1,000. Let's say you find a stock you want to buy at 100. Your exit is 10% below there, which is 90. It could be 5% or 2% or 7 or 8%. It doesn't really matter. Based on your own homework and your strategy, that's a separate story where you exit. But the idea is that you have a predetermined exit in place before you enter, and that's critical. Because without that predetermined exit in place, and in my opinion, the order is working at all times during market hours, you're allowing your emotions to get the best of you. And another reason why most people lose in this business is because they make emotional decisions, not rational decisions. So what I've learned over time is saying, okay, how do I remove my emotions from the decision-making process? And that's by doing everything when the markets are closed. Hat tip to Nicholas Darvis from the famous trading book about how I made $2 million in the stock market. And I've actually applied that, and now I do things on a weekly basis when the markets are closed, and then my orders both to get in and to get out are working all week long. Without that structure in place, I found early on in my career I was making emotional decisions. I'd get in, then I'd get out, and I wouldn't really have rules, and I want to get back in again, and it was just sloppy, and it was all over the place. And again, keep it simple. So in this case, okay, you're going to get in at 100, you're going to get out at 90, your expected loss is $10. How many shares can you buy? Well, if you want to risk $1,000 divided by 10, if you're stopped out, if you're wrong, that's 100 shares. Okay, that's how many shares you can buy at 100 with a stop of 90. Now, if the stock goes to 110 or 115 and you raise your stop to 100, that becomes a different story, and that's a different part of the equation. We're talking about the initial purchase price, and this works for long or short. Just reverse the numbers. Instead of 90, use 110, and it's the same exact formula, or logic, rather. Another way is it's really important, again, these are broad concepts for you to define your own parameters. I know people that are, again, very successful with risking 0.2% instead of 1%. Some are risking 1%, some more. Find out what's comfortable for you, because every person's different. We all like different things. We have different interests. We have different tolerances for risk and for reward. Different buttons. I mean, pardon the pun, but I love to learn what makes people tick. So everybody ticks differently, for lack of a better way of explaining it. And it's important for you to find something that works for you. I I've worked with a lot of traders and a lot of investors, and over the years, some people work very, very well with a 2% loss. Some people work great with a 6% loss, a 5% loss, a 10% loss, and larger and smaller. So you've got to find out what's good for you as far as risk from entry to exit, and also that 1%. Maybe you're good with 0.5%. You want to take more chance and more bullets. Buy more trade. Have more trades or be more active. Maybe you want more than that and be less active. So each one's different. Realize the greater you increase that 1% of your portfolio, the larger your risk becomes and the larger your drawdowns will become. The largest funds in the world, and these are both mutual funds and hedge funds and pension funds, typically use the 1% rule or less. And using that 1% rule, you can put up double-digit annual returns, especially if you pyramid with that 1% rule. But the key here is to respect the downside and let the winners take care of themselves, because the goal is to win by not losing. Simple math, the larger your drawdown, the larger recovery is going to need to get back to even. Let's take a look at this simple mathematics. Again, this is nothing proprietary here. It's very, very simple math, but most people don't even recognize that these numbers are so skewed. When you buy something, if you're down 5%, you need a 5.3% gain to get back to even. You're down 10%, you need 11.1% gain. Let's go down a little bit. 25%, you need a 33% gain. Okay, that's still not that bad. Let's look at you're down 50%. So let's say you buy a stock at 10, it goes to 5. The stock's at 5. In order for it to go back to 10, it's got to go up 5, which is 100% of 5. That's a big, big, big gain. How many times do stocks go up 100%? So even though you had a loss of only 50, you need a gain of 100 to get back to even. And go down further, 90% loss, you need 1,000% gain to get back to even. That's why it's so critical in this business, not only for the stock to keep your loss small, but also for the overall portfolio. Because the same exact math applies to both the stock and your portfolio. You have a $100,000 account, and you're down 50% to 50 grand, and now you need it to go back to 100. You need to double your money just to get back to even. That's a profound statement in and of itself. When most people don't realize that, and they just wing it and they just run and hope things just work out. Again, armed with this knowledge, it'll propel you right to the head of the game, because it's important for you to understand the numbers, because at the end of the day, that's what we're dealing with. We're dealing with numbers, both up and down. So this is a simple fact. It works for both your stops, when you from entry, and also when you have a profit, but also with your portfolio. And what the purpose of the D, the broader sense, is your portfolio. The stocks will take care of themselves. Hopefully you pick the right stocks, you buy leaders, you buy them on advanced entry points, you do them in uptrends, if you're going along, and you're able to define your risk with a good exit point, you swing the bat the right time, you're going to be stopped out. It happens, and there's nothing wrong with that. The other part of it is to realize there's nothing wrong with taking losses, as long as those losses are small, and as long as your loss to your bottom line, to your portfolio, is small. But when you start getting aggressive and take large losses, you can see the numbers here. That's where you really get in trouble, and you can get in trouble really fast. So let's break down the word risk, because risk is a complicated word that means there's many different types of risk. First of all, there's systematic risk. This was big. A lot of these terms were big back in 2008 with the whole financial crisis. Systematic risk means the whole system can come down. See you later. Back in 08, from 08 to 09, almost every asset class in the world imploded. It didn't fall, imploded. Commodities, you have corn, you have energy prices, you've got currencies, you've got stocks, you've got everything under the sun. Boom. That's systematic risk. Why? Because it was a great recession, almost a depression. Not a recession, but a great recession. And that's systematic risk, where you have a shock to an external shock, typically. Okay, credit froze. What does that mean? You can't go to the bank, you can't borrow money. Well, you can't borrow money, guess what? You can't pay your bills. You can't pay your bills, no one gets paid, people can't pay their bills, and then it's a domino, and then exponentially grows in a heartbeat. Think of like a virus that spreads. That's systematic risk. Unsystematic risk is a specific type of risk. Okay, I own 10 stocks, one stock blows up, for lack of a better word. A lot of what I'd say and do is exaggerated just to illustrate the point. So bear with me as I give these examples. One stock blows up, okay, guess what? I have 9 other stocks. My whole portfolio isn't taken down. That's specific risk. Or one industry group's under pressure, more or less, you're okay. The market risk refers to the short, intermediate, and long-term fluctuations in a specific asset class. So you have the M in DAMP is basically your goal is to align yourself with the market, align yourself with the trend. In the simplest form, you're in an uptrend or a downtrend. Or is it trending sideways? I mean, those are the only 3 possible scenarios. Define it. And then what's your time frame? Make sure it's trending in that time frame. Lots of times, recently, you had a market pullback in the short term, but intermediate and long term, it was very, very strong uptrend. Meanwhile, the S&P got hit, 4 or 5%, something like that, which is a small blip on the radar. But in the short term, it's things can change from the intermediate and long term. So make sure your time frame all your time frames are aligned. Interest rate risk. So let's talk about that for a second. Bonds, and you have currencies, and you have equities, and stocks. You have a situation here where interest rates could adversely affect other markets and other asset classes, specifically bonds, because bonds are very interest rate sensitive. But we've been in a period now, this is 2014, since the last 5 years, more or less, we've been in a zero interest rate world in modern developed countries, especially the US, with QE 1, 2, and 3, and even now QE3 is ratcheting down, but we're still printing billions of dollars every day to stimulate the market and Main Street and Wall Street, but more Wall Street. What's happening here, if interest rates start taking up, you had a taper tantrum and the scare. There's a difference between taper. I don't want to get too far into it, but increasing interest rates inherently slows down economic growth, which inherently slows down equity prices and puts pressure on bonds. You're in a situation where interest rates are at zero. They're going to go up. It's just a question of when, not if. And keep that in mind. In a more normalized environment, when you listen to this webinar in 5 or 10 or 15 or 20 years, whenever down the road, in a more normalized, hopefully at that point, normalized interest rate environment, rates fluctuate. They go up, they go down. And then, of course, the consequence, the ramifications of the different rate changes affect the underlying investments, the different asset classes. So keep in mind how your asset class relates, or how sensitive it is to interest rates. Credit risk. So mainly that's default risk. So what does it mean when a company or a country defaults? When you issue a bond, if you're a country or a company, typically countries don't default, and most grade A companies don't default either. But in 2008, the big problem was a lot of these credit rating agencies that gave out these ratings, they gave them AAA ratings and indeed they defaulted. The problem there is that they didn't understand what they were packaging and they were selling, so the ratings were out the window, and how they're still credible blows my mind. I guess there's no other alternative, but that's outside the scope of the conversation tonight. Just keep in mind, when you have credit risk, if you're especially in bonds, there's a chance that the company goes bankrupt. We saw that with GM. We saw that with a lot of these big car companies in 2008, gone. Financial companies in 2008, gone. Washington Mutual, Bear Stearns, Lehman, ... gone. And that's default risk, and it's a real risk that exists. Typically, even with stocks, we've seen stock prices go to zero because companies default, and not just default, they go to zero. So there's a little bit difference between a credit risk when a company defaults and then a company going bankrupt. At the end of the day, it's still, if you lose money, your stock goes to zero, you're toast, the company's bankrupt, it's going to be a default also. But there's a hierarchy from getting paid. But keep in mind, I don't want to get too into it, the credit risk relates to the credit from the bond with respect to the underlying issuer, whether it's a country or a company specifically. Liquidity risk. So there's a great conversation that comes up from time to time with investment in different asset classes. Liquidity basically means, can you click a mouse right here, right now, and sell and get your money? My love for equities and for capital markets in general, not the global macro space outside of stocks, but also foreign exchange and commodities and everything else under the sun that's liquid, that you can trade. You click a mouse, you can buy it. You click a mouse, you can sell it. It's a market. That's why I trade typically with highly liquid stocks. I don't deal with penny stocks. I don't deal with stocks that trade under a million shares typically, maybe 500,000 depending on the price of the stock. But more or less, I'm looking for large liquid leaders, liquid markets that I can buy in size and sell without any type of problem. That to me is priceless. Real estate is an example of an illiquid asset because I can't, I own real estate. Okay, let's say I have a condo downtown. I want to sell it right now. Yeah, it's going to take a little more time than that. And then the price you get for it isn't really reflective of right here, right now. With equities or with commodities or with currencies in the capital market space, liquid capital market space specifically, there's a bid and an ask at all times when the markets are open. And you can buy and sell based on the prices that are in front of you right there, right then. That's liquidity. So the risk of liquidity is liquidity drying up, and that's what happened in 2008 and 2009, and happened other times before briefly, but you have those periods of people there's no bids, there's nobody buying, and there's no one offering the price to sell it. So that's where that whole concept of liquidity risk comes in. I just had a member on Fine Leading Stocks. I think he mentioned a nanotech undervalued stock guy. So he had left the service after being with us for a while. He said, hey, listen, I'm leaving because I'm a nanotech undervalued stock guy. Okay, nanotech is just a nice way of saying a penny stock, and looking for cheap nanotech stock, it's just not outside of our realm. I mean, all the best, wish the guy the best of luck, but that's what my problem with that is, the liquidity risk, plus of course a lot of other problems with that world that I just don't deal with. But keep in mind, when it's very easy to fall into that trap of, oh, I can buy the stocks at a penny, it's going to go to 10, and I'll double, just be very, very careful with that whole concept of anything that trades under $10 or $15 is typically, the quality of the merchandise is not that good. Currency risk is another type of risk for you to keep in mind. Basically, it's different rates. When the currency rates change, what happens to the bottom line? So a lot of these multinational corporations that you invest in, IBM, Coca-Cola, Pepsi, a lot of their revenues come from overseas. So what happens when the overseas currency, whether it's Japan or Europe or wherever, or even China, there's a lot of, the last 5 or 10 years or so, there's been a lot of quote-unquote speculation with China controlling their yuan, their currency, and artificially affecting growth in the economy. The currency risk is extremely important, because when currency rates fluctuate violently, it matters. A few pennies here or there, not a big deal. But the US dollar imploding or going through the roof, the euro, if it's still around down the road, or the yen, major global currencies matter, especially in the global developed world that we focus on. So it matters on Wall Street. It's a secondary or tertiary thing, not a primary factor, but it's something to keep in mind, especially during times of duress. Political risk, well, we saw that. I mean, there's countless times. You had South America in the 70s and 80s. You had the Arab Spring just recently in 2011 and 12, and even recently now, it's still ongoing. You have Ukraine and Russia. There's the political risk is just it happens. It's a fact of life. Politics is a messy business. It's a lot more messy than Wall Street, and it's just, understand that if you're going to invest in emerging markets, even in some developed nations, there will be political risk, and factor that into the equation. So you have a new IPO from some Chinese company or some South American company or wherever, fill in the blank. Okay, it might seem great on paper, but what actually happens if the company implodes politically? There's a problem, and I've seen that happen multiple times before, especially when this political situation is volatile. Thankfully, ideally, the political risk is it's not a current factor. In other words, it's something to keep out there, but it doesn't really happen or affect us on a day-to-day. But there's been times, just recently with Russia and Ukraine, where Russian stocks have gotten hammered. You've seen lost a quarter, if not 30% of their value in a matter of days, if not weeks, just because of the political risk. Ukraine, forget about it. Those guys were just hammered. So keep that in mind, and that's just one recent example. I mean, there's decades and decades and decades of these examples of these political flare-ups or hotspots that just show up out of nowhere. Operational risk is another type of risk that's really important. It's very difficult to quantify this, but think 10, maybe 12 years ago in the early 2000s with Enron, operational risk. I can list 20 or 30 other companies. Look at in 2008 with all the financial companies. The operation itself, do you trust management? If you do, you're great, you're going to do well. The problem is that we're not privy, most of us at least, aren't privy to what's happening in the boardroom, what's happening in the C-suite in these publicly traded companies. And what happens if unsavory characters take over and amass control and then do things that are not legal or not ethical or not moral? And that's where you have a situation where it could potentially become very, very problematic, for lack of a better word. So the next area is portfolio heat. Portfolio heat refers to your actual portfolio. This is somewhat of a complex subject or concept to keep in mind, because what happens is all of us, from that psychological standpoint, have a certain point where you cry uncle and you give up. You say, okay, I can withdraw a 5% pullback in my portfolio. I can withdraw a 10%, 20, whatever the case is. But you get to a certain point where, I hope not, but early on, happens to most people until they can detach themselves and really get this concept of the defense first, inbred into their psyche, and more importantly into their portfolio, where you lose sleep, you sweat, whatever it is. That's what that portfolio heat reflects. What's the true value of your portfolio if all of your stops are elected right here, right now, for whatever reason? Are you going to be okay with that? And if the answer is yes, okay, you're comfortable. The heat's low. If the answer is no, tighten your stops or reduce your overall position. And you're the one who sets that.
Thank you all for watching, and we hope that you enjoyed this video. If you were watching us on YouTube, please take a moment and click the like button here at the bottom, and also take a moment to subscribe to us here on YouTube. If you'd like to try out Adam Sarhan's Find Leading Stocks service and see all of these concepts in action, visit findleadingstocks.com and save 10% off of any membership level when you sign up. Simply go to findleadingstocks.com, enter discount code CYT, and claim your 10% discount. Thanks again for watching, and have a great day.